Hi everyone, welcome to today's video. So on today's video, we are going to understand why are big investors so bullish about Indian tech industry right now. There is a specific report that has come out by Motilal Oswal Financial Services, led by Mr. Raamdeo Agrawal. He has spoken about that India is going to see a massive growth in its tech landscape, and that is where wealth creators are going to come up. So through this video, we are going to understand whether it makes sense to invest in Indian tech companies right now. If yes, what type of companies should we pick and what are some of the key things that we should remember? So I have structured this video into 4 parts. One is that I'm going to help you understand more about Mr. Raamdeo Agrawal's investment philosophy because he has led this wealth creation report. Second, we are going to understand what has been covered by this wealth creation report and why is Mr. Raamdeo Agrawal and Motilal Oswal Financial Services is so bullish about Indian tech industry. And finally, I will leave you with a very good investment strategy across different Indian tech companies. How you should do it. Please watch the video till the very end. Make notes. It's going to be a really important video in case you are betting on Indian tech industry. So the first key argument in terms of investing in the Indian tech landscape is fairly simple. And according to Mr. Raamdeo Agrawal, there is a value migration that is happening to Indian tech industry. Mr. Raamdeo Agrawal gives out really interesting frameworks. So I will quickly encapsulate 2 specific frameworks for you. In case you're not interested, you can skip this section, move on to the next section. But super important, super interesting aspect that can help you analyze other businesses also. So the first key framework he speaks about is the value migration frameworks. What does it simply mean? It simply means that there are certain industries, certain type of companies which lose value in a changing economy, and then there are certain set of companies or industries that gain value. So let us understand that by using a very simple example about banks that Mr. Raamdeo Agrawal frequently uses. So in the 90s, the PSU banks in India were very prominent and there was a lot of value that was there with PSU banks. Unfortunately, they were not performing really well. Okay, time for an SBI joke. Okay, no, I'll leave it. I'll not make an SBI joke today. Basically, we are all smart enough to understand that there was a lot of bad stuff that was happening with PSU banks. And therefore, the value migrated from PSU banks to private sector banks starting from mid-90s. And that is when HDFC Bank, ICICI Bank, Kotak Bank took away a lot of market share from PSU banks. So the value migration happened from PSU banks to private banks. Now something similar is happening in the economy right now, that a lot of value migration is happening from atom to bits, right? So now this is a framework that Mr. Raamdeo Agrawal has suggested, and he calls it atom to bits framework. So atom companies in simple words mean infrastructure driven companies. For example, if you talk about HUL. Now what is HUL? HUL is basically would be a collection of a bunch of factories. They'll be producing a lot of shampoo, soaps, hair oil, and they will be selling it. So it's a pure physical play, so to say. Yes, even a company like HUL will have a digital part to it, which I'll explain subsequently. But to cut the long story short, these are called as atom companies, which are very infrastructure driven. On the flip side, you have companies like InfoEdge, you have companies like Infosys, you have companies like TCS, which are bits, which are pure digital companies. A classic example of this will be Microsoft. For example, Microsoft, what is the major power? If you calculate the market cap of Microsoft, that market cap does not come from how many offices Microsoft has built. It mostly comes from intellectual property, which is not a tangible asset. So these are called as bits type of companies. And according to the value migration framework of Mr. Raamdeo Agrawal, the value is getting transferred from atom type of companies to bits type of companies. This is part A. Part B. Even in atom type of companies, there are certain companies. For example, if you take a look at something like Asian Paints or HUL, they have access to a lot of data. They do a lot of customer study by using that data, analyzing that data. They optimize their value chain, their distribution network by using what? By using digital data. So to an extent, these companies like Asian Paints, HUL, Nestle, they are very good at optimizing their processes by using digital play. So there are certain elements of bits even in these atom companies. Now you don't need to understand the exact difference between atom and bits. I'm just setting the context because this is the wealth creation study, which was done by Motilal Oswal Financial Services, and they have talked a lot about atoms and bits. I will link this study in the description box. Also, I have created some of the small cases. You can take a look at it. Those are excellent small cases. Because the markets are falling, there is a great buying opportunities in these small cases. Okay, so let's continue our discussion. This is the first key framework which Mr. Raamdeo Agrawal quite extensively speaks about. Second, he speaks about a framework called as QGLP. I will be brief in terms of explaining it. QGLP is an internal buying framework. It simply means Q stands for quality, G stands for growth, L stands for longevity, P stands for price. So if you're getting a great company at a great price, buy it. So that is what QGLP simply means. I had made a separate video on that. You can watch it separately. But again, this is a Mr. Raamdeo Agrawal's framework. Therefore, I'm bringing it up. So for the purpose of our discussion today, we will limit our conversation to atoms to bits framework, which is an advanced value migration framework. And we will study Indian tech companies in that context. Now, here are some of the key highlights from this wealth creation study. It's very important for us to understand this history because if we understand these concepts well, we can try to replicate it and generate massive returns going forward in the future. This is the first chart that you need to take a look at, and it categorically points out to the fastest wealth creators, the most consistent wealth creators, the biggest wealth creators. So here you have companies like Reliance, Hindustan Unilever, Bajaj Finance. They have been consistent wealth creators. Now, one point about Reliance, because you might get misguided by looking at this study, that between the period 2008 to 2018, Reliance did not give any returns, literally very less return. It started going up from 2018 onwards. So there was a big dormant phase for Reliance. And this study has been done from 2016 to 2021, right? So please see Reliance in that context, keeping that information at play. All these companies that are listed on this chart are excellent companies. And this allows us to understand how historically India has grown in the last 5 years and which companies have given the most return. Now, this is chart number 2, and this is very, very fascinating. It simply says that in the last 5 years, most wealth has been added. Almost 71 trillion INR rupees of wealth has been added to Indian companies or in Indian stocks. Now, this is a massive number and you can derive a lot of information from it. For example, you can clearly ascribe to the fact that 71 trillion rupees have been added. So India is becoming a destination where a lot of money is flowing into India. So this is a good news for stock investors in India. Second, you can look at this data from the point of view that, hey, you know what, a lot of money printing has happened. So probably assets got inflated because of that. Now, no further information has been given. So we can't say that which of the reasons is here, but it's a combination of both these things. But what is most important about this historic context is fairly simple, that India as a destination for investors is growing. I often talk about India is rather witnessing a bull run, barring the last 2 months. So it's a good time to be an investor in India. And going forward, the story looks very optimistic from India's point of view. So let's start analyzing the future a little bit as well. And here is an excellent quote that was given on this report. And it simply says that whatever can be digital will become digital. And that I agree with 100%. That almost everything, even if you look around, even local fruit walas or sabzi walas are accepting Paytm and UPI payments. So even they are trying to go digital to a certain extent. So whatever can become digital will become digital. There is absolutely no doubt about that. But a more important point we need to understand is why. Why will that happen? Because the more digital you go, the more profit margins improve. For example, if you take a look at the profit margins for companies like Microsoft, Facebook, Google, Apple, the margins are insane because they are selling a lot of digital intellectual property. For example, Microsoft, when it sells a piece of code or a particular software, the marginal cost. So marginal cost simply means the amount of money required to produce that one unit of software. Right? So to create one more copy of Microsoft Excel or Microsoft Word, Microsoft does not have to spend almost any money on it. So the marginal cost is zero for a company like Microsoft. And given that these tech companies have such high profit margins, almost all companies, even atom companies, are trying to digitize everything that they can digitize. So everything is becoming digital. There is absolutely no doubt about that. Now, here is a very good framework that Mr. Raamdeo Agrawal has suggested. And this is a list of key traits or key attributes which a good bits company should exhibit. For example, the market size should be large enough. The problem that they are solving should be big enough for them to enter and make money in it. Similarly, it should exhibit some kind of network effect. It should have a good distribution and bunch of different factors that he has outlined. You can go through this list. The report also explains a bunch of different formats. For example, what type of bits business or digital businesses are there. For example, there are portal plays, there are platform plays, there is subscription or feed-based services that exhibit. So you can read all these examples. I'm not going into the description of each of these services. All of us can easily understand it by looking at these examples. So fairly easy for us to understand that a lot of different types of digital businesses are coming up. So all these different types of digital businesses are coming up in India. Now comes the question that, hey, can these type of businesses survive in a country like India? A great example would be to take a look at how these businesses have done in the US. So here is a comparison between Bits and Atoms type of companies in the US, what their growth rate has been in the last 1 decade. And you can clearly see that companies like Facebook, Amazon, Netflix, Google, FANG companies, they have generated so much return compared to Atom type of companies, which are Coca-Cola, Walmart, ExxonMobil, etc. What is the key takeaway? The key takeaway is that, hey, in the US, the trend is very clear that if you want to grow your money, go and invest in tech. People who have invested in tech in the last 1 decade have become really rich, and people who have invested in Atom type of companies, their wealth has hardly grown. So would that same scenario play out in a country like India? That is what we need to debate. And a great way to look at it is to look at some of the recent listing of companies that have taken place. And what type of financial history do these companies have? So here is a list of major companies that got listed in India recently. This would be Nykaa, this would be Zomato, this would be Nazara Technologies, this would be IndiaMart, Nazara Technologies. So all these companies have been listed. So should you go and invest in all these companies? I will answer this question towards the end. But the short answer is that it depends on what type of an investor you are and how you are looking at these technology companies and what type of stories you are believing in about these companies. Because as you can see, majority of these companies are currently loss-making companies, and you can actually get hit really, really badly if you go and invest in it. So for example, let us quickly understand it by using the example of Zomato. Here are some of the major numbers associated with Zomato that has been represented in the report. For example, it is said that Zomato has a big opportunity ahead because India is a growing nation and the internet penetration compared to the US or China is not still very, very high. People are not ordering that much from restaurants as of now, and this number is only going to pick up. And I agree, no doubt about that. Second thing that has been shown is the unit economics. Unit economics simply means that, hey, if Zomato is selling 1 unit of its product, are they making a profit? Are they making a loss? How much profit? How much loss? So right now, the average order value in 2021 from Zomato is 400 rupees. They are charging a commission from 15%. They have been successfully able to grow their revenues from restaurants, and their contribution per order comes out to be 19 rupees. So its unit economics has been turned positive. So does that mean that you should go and buy Zomato? That's a question that you need to ask yourself, because a positive story has been presented, but you need to do a much more detailed due diligence on such companies. I'm just using Zomato as an example. For example, in this growth story that has been outlined, you need to consider the fact at what rate the internet penetration will go up in a country like India. That's one. Second, it has been assumed in the story that, a large chunk of people will continue to order food outside their home. For example, US rates have been quoted. Now in the US, if you actually go and stay there for a little bit, you yourself will see that a large chunk of people in New York, they will have their morning coffee also from Starbucks. They will grab their breakfast on their way to work. That culture is not there in India yet. Will it happen? I don't know. But that is the story that right now everyone is believing in when they are investing in Zomato, that same culture will get implemented in a country like India. Another key aspect that we miss is the aspect of competition. For example, companies like Zomato or companies like Paytm, they are facing stiff competition. It is usually assumed that in digital businesses that whenever a company attains a scale, for example, Microsoft is an intellectual property monopoly. For example, if you're using Microsoft Word, there is just one thing like Microsoft Word. There is no second company even touching close to Microsoft Word or Microsoft Excel. It's a monopoly. It's an IP monopoly, intellectual property monopoly. That is not replicable for a company like Zomato because it has very close competitor in the form of Swiggy. And Paytm is still pivoting and trying to discover its business model. We don't know whom exactly is it competing with. So this brings me to the final section of the video, that what are my thought processes and investment advice for you in case you're looking to invest in Indian companies. Number one, I am personally taking more bets on the next Google, next Amazon, next Facebook, and those companies are by default in the US right now. So I'm taking more of my technology bets in the US. Second, am I bullish about Indian tech sector? Yes, because I do feel that businesses are going to get digitized, as stated in Motilal Oswal Financial Services report also. But there is a small caveat, right? And this is something that Mr. Raamdeo Agrawal has also said. Only a handful of these companies are going to survive. Now, the important point for me as an investor is that since I don't know what Paytm is exactly doing, I don't know to what extent, at what pace Zomato is going to grow, because every time they miss their quarterly earning, for example, even if Zomato revenues stay positive, if their growth rate slows down for whatever reasons, then their share prices will fall. And I genuinely feel that there will be many such corrections that will happen along the way. And those would be the buying opportunities in these type of companies. So two final thoughts. One is that if I'm using my brain and if I'm trying to pick stocks in Indian tech, it will be very difficult for me because I don't know that which of these companies will be clear winners between Zomato, Swiggy, which one will win, which one will not win. I don't know. Similarly, what is Paytm trying to do? I don't know to what extent its business model will keep on pivoting. There is absolutely no idea even market has that to what extent Paytm will continue to pivot. So there are two investment strategies that I can use. One is that I can use my brain and try to become a very intelligent, smart investor who will be great at picking companies. But honestly, even the management of these companies are not super clear about the business model as of now. For example, it is said that for Zomato, grocery space will become really big. That model has not become extensive. So there is no point in me using my brain here too much. What I would do and I would advise here is to do punter investing, right? So punter investing simply means that, for example, if you have to invest 1 lakh in your tech stocks in India, go and split it in these recently listed 10 companies, equal amount. Some of them will win, most of them will lose. Your 10,000 that are winner, so out of 1 lakh, let's say 9 companies close down, but one company survives, that one company is going to give you 20x gain. So your 1 lakh still becomes 2 lakhs from that perspective. So this is pretty much brainless investing in my opinion. In a market which is driven by stories, I'm being honest with you, this is the most sensible way of investing. That is what I am following. This is not an investment advice. I'm just telling you that this is something that I could consider doing given the current landscape of Indian tech investments. Thank you so much. I hope you enjoyed the video and I will see you the next time.